Did you know that a lot of people end up having to pay taxes on their Social Security benefits in retirement? This is something that catches a lot of retirees by surprise. So, in today's video, we're going to talk about how benefits are taxed and how you might be impacted by that. So, let's check it out. Back in 1983, Congress made some large changes to Social Security to help address future solvency issues. And one of those changes that came out of that was the taxation of benefits. So this has been around for 40 years now. And what they did is they came up with what's called combined income, a formula to determine how much of your Social Security you may have to report every single year. And there's three parts to it. It's also known as provisional income. The first component is your adjusted gross income, which is basically the total of all income sources you have in a given year. That can be wages, that can be distributions from retirement accounts like IRAs, pension income, annuity income, if you own real estate, even capital gains. All of that is rolled into your adjusted gross income, and that's the first component. The second is what's known as non-taxable interest income, and this is most commonly the income you get from municipal bonds. There are a lot of retirees that like owning muni bonds because the income itself is not subject to federal income tax, which is a nice benefit. However, because they know many retirees own that, they still bring that income back into the equation when determining the combined income amount. So that's the second component. And then the third component is half of what you're actually getting in Social Security, half of your benefit is brought into the mix. So when they add up your adjusted gross income, any non-taxable interest income, and then half of your Social Security, that gets you that combined income number. Once your combined income has been calculated, the IRS has different tiers of income that they'll apply that to determine how much, what percentage you may have to report. And that amount changes based upon your filing status. If you're a single filer and your combined income is below $25,000, then you don't have to report any of your benefits for tax purposes. If it's between $25,000 and $34,000, then up to 50% of your benefits may be subject to tax. And then if it's above $34,000, then up to 85% of your Social Security may be taxable for the year. For married filing jointly, those numbers are just increased ever so slightly. If it's under $32,000, again, you don't have to report any income for the year for Social Security. If it's between $32,000 and $44,000, then up to half of that may be subject to tax. And if it's above $44,000, then up to 85% may have to be reported. And as you can see, these numbers are fairly low, and that's because they've never been adjusted since benefits have first became taxable. So over 40 years, they have not been adjusted for inflation, even though incomes have risen over time. So as you can see, it doesn't really take a whole lot of income in retirement to have a good portion of your benefits subject to taxes each year. Social Security is a really important part to nearly everybody's retirement plan. And for anyone who's done a good job of saving for retirement beyond just Social Security, well, there's a good chance that you're going to have to report a portion, if not a good portion, of those benefits for tax purposes each year. So it's just something that you need to be aware of and plan for because there's a good chance that it's going to happen. I hope you found this information helpful. If so, feel free to check out these other videos. Thank you for watching, and we'll see you in the next video.